If you're looking to put some more risk in your investment portfolio, you might want to take a look at some earning trades. I'm Tom Preston, Chief Market Strategist at tastylive. In this week's Cherry Picks, the guys put some very interesting data about earnings on the stocks. So let's take a look about all that information and watch till the end, and we'll check out two possible trades based on this information. Mike Reckentine and Nick Batista put out the upcoming earnings calendar, and as they say, hundreds of stocks are coming out in this week in the middle of July. What happens around earnings is the market is kind of holding its breath. The stock, the analysts put out expectations for the profits or losses that a stock might have, in other words, the earnings per share. And when the information actually comes out, during an earnings call, the market can see a number that they expect, in which case the stock doesn't move much at all, or much higher or lower, in other words, more profits or bigger losses than they expected, and send the stock soaring or dropping very sharply, very quickly. That's why earnings trades can have a lot more risk than your standard investments, let's say trading outside of earnings or trading index products or ETFs, that sort of thing. If you do want to take more risk, earnings are a place to look. What the guys did is put together a really interesting spreadsheet, and it says download the full list here, so I'm going to click on that. What it is, and I'm not going to go over every single number in here, but I'm going to hit the high points. SLB comes out, the earnings expected to be announced on Friday, July 19th. They come out before the open, so before 8:30 Central Time. What they show is based on 6 years of quarterly earnings. So the guys went back and looked at the past 24 earnings announcements. 6 years, there are usually 4 earnings announcements per year, so 6 times 4 is 24. And they counted the number of times that the stock was up overnight or the next day after the earnings came out. And they counted the number, so in other words, if you have 24 days, or 24 instances, and the stock went up 12 times afterwards, then the stock rallied 50% of the time after earnings. That's what this number actually means. Now, past is not prologue. It doesn't mean that if it went up 50 or 60 or 70% of the time after earnings over the past 6 years, that it will do so again. So just understand that. Place your bets accordingly, okay? So Schlumberger, for example, over the past 6 years went up 57% of the time. And the average, or the median move afterwards was 1%. The biggest down move was 5%, pretty big. Biggest up move was 6%. And the standard deviation range, or the range, the 68% range was 1.6%. So not very big, okay? But it's big enough, you know, down 5%, up 6%, that's what's possible. Well, much bigger moves are possible. But if that's the range that you might see, then that can help you pick a strategy to take advantage of that. And it also points out, this information also points out the IV rank and the overall implied volatility. Now, the IV rank tells you how high the implied volatility is relative to the past 52 weeks of volatility data. And the overall implied volatility is an indication how rich the options might be. That's one way to think about it. 44% is pretty good. So if you're looking to make a trade around earnings, this type of information can be informative. So let's take a look at SLB, just for the SLB, Schlumberger. It's an oil field services stock coming out on July 19th. Let's just check and see what the one-day options are doing. Depending on which expiration you choose, if you want to take more risk, yeah, you can trade a one-day option or two-day option in these things. The problem with that is the trades tend to be very binary. When you only have 1 day to trade it, if the stock makes a huge move against you, there's not a whole lot of time for the stock to recover. So just be cautious, but I'm going to do this instead. And so what do the guys point out, cherry picks? They say that on average, it was 1%. Okay, all right, let's see what 1% is for Schlumberger. So that's about 1% here is about, oh, I don't know, let's say 50 cents or so. If I wanted to sell some premium out here, I might look, I would go a little bit wider. One of the things I would look at is the expected move here, which is based on the straddle and strangle prices. And trading options is all about a combination of information. I never just use one metric. One day, and this would happen before the earnings come out. So if I wanted to, let's say, well, they come out actually that day. So if I wanted to, let's say a buck and a half out of the money. So from about 49, let's say, let's do the 47.5, and the 51s, let's say, $2 higher. Or no, actually no, let's do the 50s here. That's a little bit closer to $1.50. So the 47.5, 50 strangle, if I were to sell that, I'd collect about a 67-cent credit. A very low probability of making 50% because there's so much time here. I'd make $60 of theta on this trade because basically it's one day. If it moves outside of that range, I'm toast. There's not a whole lot that you can do with a one-day strangle. Let's go out to further expiration, let's say 8 days. And again, let's look at maybe the 47s and the 51s, let's say. Here you get some more credit, 86 cents of credit. Again, the max loss is undefined if the stock goes infinitely high or down to zero. So the loss can be very big at this sort of trade. The buying power effect is $784. Not a huge dollar amount, but again, something a smaller account could handle if you want to take the risk in this. 73% probability of making half its profit before expiration, which would happen probably in the next few days. If I wanted to define the risk on this, I would buy, let's say, to go to 2 points out of the money, turn this short strangle into an iron condor, buy the 46 puts, buy the 53 calls, turn this into an iron condor. I think this is if you are just starting out as a trader, or you're just starting out trading earnings, defined risk strategies like iron condors as opposed to short strangles you can learn about trading around earnings without getting killed. Okay, that's what it does. The max loss here is $147. If you can handle a $147 loss, consider this iron condor. It has a 66% chance of making half its max profit, which is about what, 27 cents, and yeah, generates $4 of theta every day and requires only $147 of capital. So this is the sort of trade, if you want to trade earnings, if you want to get a taste of the risk of an earnings trade, a short iron condor in something like SLB, Schlumberger, might do it for you. Let's go back to cherry pick, excuse me. I would go down, the way I would use this information is I would go down and look for the highest IV rank. So Verizon, CLF, which is what Cliffs Natural Resources, even maybe Coca-Cola, Philip Morris, 61%, LMT, UPS. UPS is a little bit hard to trade. I don't know if it's that liquid, but I would look at some of these stocks with the highest IV ranks to start narrowing down the process. Then go over here, maybe bias it towards, let's say you're bullish. Hey, maybe you're just bullish on Schlumberger. It went up 57% of the time after. Instead of an iron condor, maybe just sell a put spread. Okay, something like that. Or the same thing in Verizon. Let's go to VZ. Comes out July 22nd. If it goes up 57% of the time afterwards, take a look at Verizon. Maybe you're bullish on Verizon. Again, there's nothing to say that Verizon is going to go higher, but if you are bullish, if you think that it might rally after earnings, maybe take a look at sell the 41.5, buy the 40.5. Credit's a little slim. I'd like to see a little over 30 cents for that, but it is what it is. For 8 days, that's not bad. And you can it only requires $71 of capital, so it's suitable for a smaller sized account. Generates $1.10 or $1.11 of theta, daily theta. That's pretty good. This is how I would interpret this information. Again, if you're bullish, could be bearish on Verizon, you do the opposite, sell a call spread. But this is how I would interpret this information and turn it into a trade. And Verizon has reasonable liquidity. How many stars does it get? Has 4 stars of liquidity. It's not a bad trading product. All right, let's keep going with the cherry picks. So this information is free. If you're subscribing to Cherry Picks, there's all sorts of information in here. So they tell you how it's calculated, which I already kind of covered, but if you have any questions about it, you can reach the guys here. What we've seen, at least about when the Cherry Picks came out, the small caps were finally rallying. Like IWM had a massive rally higher before everything sold off in the past couple of days, which is just kind of interesting. You know, why are they selling off? To me, the why isn't important as the what. If you think interest rates are going to be cut in the next couple of months, if you think that the political and economic uncertainty over the next couple of months is going to subside and the market's going to start drifting higher again, you can see this is a bullish opportunity. So one of the things that guys are looking at is Netflix, which is also is the first of the mega caps, and mega caps are the ones with, you know, $1 trillion+ of market cap. So they come out July 18th after the close. Let's take a look at, and they're considering an iron condor that is short. It's a 10-point iron condor, which is about what you'd want for a $500, $600 stock. This 565, 575 put spread and the 735, 745 call spread in the August expiration. Let's take a look at that trade. What's appealing about Netflix is its extremely high IV rank. You're getting rewarded for taking risks. Now Netflix can move. If you look at a chart on Netflix, this is Netflix and have these massive gaps, gap up and down. That's why we're looking at an iron condor here. They're going after the August expiration. It is the 65-75 put spread. So I'll buy this and I'll sell that. 735, 745 call spread. I take in a decent credit for this, $5, which is half of the width of the strikes. That's pretty generous for this, but that's what you get when you have very high implied volatilities. Again, 73% probability of making half your profit before then, make $6.22. Your max loss is $500. You know, that's within the range of a smallish account if you wanted to trade stock like earnings. And yeah, if you're going to trade Netflix earnings, this is $650 stock. You know, a 1% move is $6. A 10% move is $60. That'll blow right through any short strangle you have. Okay, so defined risk trades, yeah, I would suggest doing that. I would push this out a little bit to target that third of the width of the strikes. Let's see and this is how I do it. I just start moving the strikes around. Let's go out to here. That's a little too cheap. So I'm looking for $1.60. Yeah, this one actually. If I were neutral and I wanted to take less risk on this, again, I'm targeting a third of the width of the strikes for a 5-point iron condor. That's about $1.60, $1.66 or so. And this one has 78% chance of making 50% of its max profit, generates $3.20 or so of theta, has a max loss of $333. So that's how, this is a couple of ways to trade Netflix earnings. If this iron condor, an iron condor out in August is going to take a little bit more time for it to lose its value, so be prepared to hang on to that. But it also, 29 days to expiration, also gives you more flexibility, more time for the stock to recover if it makes a big move against you. Let's take a look at the next one I'm talking about is the coin trade. So Coinbase is one of the largest, if not the largest, crypto exchanges in America anyway, and probably one of the biggest in the world. It's rallied through the recent Bitcoin move. Earnings should be reported in early August. With the added trading activity, you think they might approach recent highs of 280. A broken wing butterfly might fit that assumption. So let's remember what a broken wing butterfly is. Broken wing, unbalanced, whatever you want to call it. It's a butterfly. A regular butterfly has equidistant strikes. So looking at the 280, 300, those strikes. An equidistant butterfly would be the 280 call, the 300 call, and the 320 call. So buy the 280, sell 2 of the 300s, buy 1 of the 320s. That is a butterfly. Let's load it up so you can see what that is. 52% IV rank, not bad. As we go into August here, like I said, this is a butterfly. If I buy one of these and sell 2 of these and buy 1 of these, this is a butterfly, okay? 280 to 300 is 20, 300 to 320 is $20, okay? So this is equidistant. What an unbalanced or broken wing butterfly is when you do this. They're pulling this out to 330, Yeah, the 330. You're still paying about 97 debit, which is a little steep for this. What you're doing with this trade is you're taking this butterfly and you are adding in the 320, 330 short call vertical. So remember this. So the $1.28 debit, move this out. The broken wing butterfly is a 97 debit. Let's just take a look to prove the point. If I just sell this 20-30 call spread, 31 cents. If I take that $1.28, subtract off 31 cents of credit, I get that 98 cents or 99 cents, or dollar, excuse me, the 97, 98 cents for the unbalanced butterfly. This really is where your risk is in the unbalanced butterfly. It's that embedded short call vertical. This is a bullish trade if you have a slight bullish bias towards it, but you don't think it's going to go crazy. So if I were going to do this trade for $97 of risk, well, actually, no, it's more than that. I'm paying $97 for this. It's kind of steep, but for a $230 stock, that's what you're paying for this stuff. It has a max loss of 1,097, and that's if the stock blows through 320, okay? If you just had this, the max loss is only 128. You break the wing and you add that short call vertical, the max loss rises dramatically. But again, it gives you some more positive theta. If I just do this, my theta is negative here. If I add the short call vertical, my theta pops to positive. Yeah, if you're going to trade Coinbase, and it's been rallying, sold off a little bit recently, but if you think it might rally back and don't want to take a whole lot of risk and want some positive theta, again, you could make a trade like this. This $1,000 of buying power effect, I'd say, is for slightly larger accounts. Coinbase is an expensive stock to trade because it's $230 and it's 80% volatility. So those are two possibilities: Netflix, Iron Condor, Coinbase, unbalanced or broken wing butterfly. If you want to get these cherry picks delivered to your inbox every week and my daily cherry bombs with trade ideas every day, click on the link below.